My name's Andrew Talbot, and I work at expatfinancialplanning.com. And today we're going to do some year-end planning. So let me just share this with you. Go. Let's go to the first one. Okay, there we go. So as I said, we're going to go through end of year planning. If you're watching this on YouTube, by all means get in contact with us with the normal channels that will be at the end of the presentation or the end of this video. Go to expatfinancialplanning.com is a good start. If you're doing this on Zoom and you want to ask questions, by all means just ask a question and I should be able to pick it up, and we can go through that at that point. So today we are going to do financial planning for the year end, and generally it's because it's a psychological point. It's the end of the year, it's the new year. It's always a good reflection point to say, okay, how have I done this year? What am I going to do next year? So if you're taking time off over the Christmas period and you just want to sit down for an afternoon or some point when you're not with a mince pie or something along those lines, mulled wine, then just look at your finances to make it a little bit more bearable. Then the end of the year is always a good point to do that, rather than maybe starting it in the new year and you're ready to go at that point. So it's as I said, it's a very good point to start. Some of the things to think about when you're doing this is what do you need to do? So first of all is discover where you are with those personal finances. So have a look at any valuations that you've got, get all those insurance policies out, update your spreadsheet, do your budgeting or your spending plan, see whether or not you've done that. We'll come on to that later. So making sure that where you are, what's it looking like? What are your finances looking like? So if you've got personal finance software, update that. Produce your little report for yourself to say, well, this is what happened during this year. Do some administration. Sometimes I'll go around to people's houses, or clients will come in and they'll say, here is my financial life, and there's just stacks of paperwork. Some of it is completely irrelevant. You just don't need it. So we always say, keep the last statement. The previous stuff, either upload it, scan it, get rid of it, shred it, get rid of it, get it out of your life. Your paperwork should be pretty minimal these days. Everything should really be saved on a sort of a cloud somewhere or on your computer, password protected, but make sure that your admin's up and running. It helps with the planning going forward. And then understand what changes need to be made. So if you've done that budget plan, budget or spending plan, do you need to make changes to that because you're going to be spending more, or you're going to be spending less, or you want to be able to go on holiday next year? You decided that you're actually going to maybe finish your expat posting or return home or go to a new country or buy a new asset. So what changes do you think you need to be made? And then you've got to discover, well, how do I make them? Do I need to employ a financial planner? Do I need to just go to the bank? Do I need to make changes to my asset allocation because some of my objectives maybe have changed? So it's understanding, okay, what are those changes and how do we be made? So if you've had another family member, then do you need to increase your insurance, or have you bought a new house? Do you need to increase your insurance? There's another example of a change and how you make it. And then it's really understanding what is the most important part of the goals and the objectives, or the factors that you need to monitor. So if you're overspending every year, do you need to monitor that? Do you need to think of a budgeting app or some software that will help you monitor or change your behavior when it comes to spending? Do you need to make sure that you've got different bank accounts, set up another bank account in order to have savings? These are some of the factors that you can help monitor that maybe help you with your behavior when it comes to kind of spending. And it's the same with investments. Do you need to monitor what's going on? generally you shouldn't touch investments. It's a bit like soap. The more you touch it, the more it disappears. So don't touch your investments until the point that you need to sell it. Your asset allocation should be down to your goals and objectives, should be in globally diversified companies. Some of the best companies in the world, the great companies of the planet. That's what you get invested in. So understanding which parts of the plan are important. Plan your bucket list as an example. So if you're saying, oh, I want to go on holiday 3 or 4 times a year, I want to buy that house, I want to be able to have my retirement home paid off or my mortgage paid off. I want to be able to know that I'm on track for that amount I'm going to be spending when I go into retirement. Then these are the goals and objectives that you need to plan as you're going through with your financial plan. And we'll come on to some more details about that now. So assess those assets and liabilities, include income expenditure, add your goals and aspirations, work out if there's any future changes that are going to come up. Kids might go to school, you might have to move countries, you might buy a house. Allow for these economic conditions. I mean, at the moment, the markets are, as we say, volatile. The intraday, the changes that happen within one day are quite severe. There's big falls and there's big highs. So these are some of the economic conditions that exist at the moment. Will that affect your financial planning into the future? It's unlikely. But understanding, okay, what is news that I need to take advantage of or listen to, and what is just noise. So you've got to tune out that noise. And this will help with identifying any shortfalls or surpluses throughout your lifetime. So as you change those goals and those aspirations, you add it in your bucket list. Are you going to have a shortfall? Are you going to be able to fund this? Or are you not spending enough when it comes into retirement? Or do you not have enough bucket lists or goals and aspirations that you can probably fund because you just don't know? So you've got a large surplus, whereas actually you could be taking advantage of this. So this is where a plan will come into it. This is what financial planning is understanding you as an individual. And then what we do is we explore these what if scenarios, which are the most important to know the information, the data to describe, to give you that information to help you make those decisions. So if you wanted to buy a house, can you afford it? How do we plan that? And that's just a financial plan, covering all of those objectives. So how does the planning work? I mean, real life is unpredictable and it's changing. There's things that are involved in your life that are important, that should be put into the financial plan. So it's collaboratively, it's got to be as collaborative as possible so that your financial plan has all of your goals and all your aspirations in there, and it's about you rather than just an off-the-shelf, here's a plan that you can download, or it's not about you, it's just a generic plan. So it's got to be about yourself. You got to add your goals, you got to add your aspirations into it, and then you've got to add all of your what we call the raw data. So your earnings, your expenditure, so current expenditure, what your future expenditure is going to look like, and this could be those bucket lists. So for instance, we've got sort of family, personal, holidays, luxury, leisure. That luxury could be, well, I want to go on holiday. I want to buy that house. I want to send my kids to a university in Australia, UK, US. So you've got to add in what that future expenditures looks like. And then all those assets, and to extent the liabilities as well. Mortgages, what happens if you overpay on the mortgage, that type of thing. What's the current interest rate? How much am I paying? How much is my rent if it's rented out? What is my where are my assets? What's my investment portfolio looking like? Do I have a business? What's my cash savings, etc.? All of these things that will add to your data to produce the financial plan. And then another very important point is to understand, well, what are those assumptions when we come to that data? Are you going to earn more in the coming year, or next year? Do you need to build into the fact that you're going to have more income? What about your expenses? We talked about kids going to university or to school. Are those costs going to increase every year? At which point, what is the cost of those increases? What are they? How much are we going to spend on household expenses? How much are we going to spend on holidays? Do we have any expenditure that's going to go up? And then what are those assumptions? Because inflation is going up in that particular location or your home country. It's the same with investment assets. If you've got an investment portfolio, what return are you expecting from that investment return? And is that reasonable? If you're looking for equity-like return, but half your portfolio is in fixed interest, then you're unlikely to get that equity return. So you've got to understand what those assumptions look like and the behavior that goes along with it. Previously, we said that markets are volatile. We've had this correction over the last 6 weeks where it's maybe dropped 10% minimum, maybe more than that. How is that going to affect your portfolio? And how is that going to affect the longer term if your investment returns are maybe less than what you expected them to be this year? So you've got to add those assumptions in. What are they going to be like next year? So what interest rate investment return are you going to apply to each of those investments? And they should be individual rather than one overall plan. And then we're looking at, okay, what about loans and credit cards and everything else? So what about those returns? A change in the investment return, a change in the mortgage, a change in inflation can have a big difference to how you will earn money over the longer term. The longer the period, the more the variance can be if you change the inflation rate or the investment return by like 0.5% or 1%. So it's very important to understand what that is. So let's start crunching the numbers. Let's work out what these what if scenarios are and adding them into your plan. So what if you pay off your mortgage in 10 years time? How do you do that? Do you need to make overpayments? Will it affect your future finances if you're taking your investments and you're putting it into your mortgage? So it's important to understand what these what if scenarios. Can I take a rental property from an inheritance? And will that affect my retirement income? Maybe the property is part of your retirement streams, your income streams in the future. Do you need to add more properties in to make up that retirement income? How much is enough? So there's lots of different scenarios, and we can add a few more here where I'm saying how much is enough for retirement? Can I retire earlier? Can I quit my job now? We've had examples when we've done the financial plan for an individual. They know that they can quit their job. They know that they can retire earlier. So their behavior when it comes to work has changed because they're much more comfortable that they don't need to take the stress on, and is actually resulting in them enjoying work now because they know they can just leave. So having that financial plan has helped them change their life, their behavior when it comes to work. They may want to, they may know that they can retire, but it doesn't necessarily mean that they want to. So then the stress has come off. You can be a bit better at your job. You may actually get a promotion as a result of this, knowing that you can just walk away tomorrow because you've got that data, you've got that plan for you. If you want to give your children, your daughter, for instance, £30,000 to buy a house, can you get the money from a particular investment? What will the impact be on someone's life, or your retirement, or your financial life if you did that? And then we're into other areas to say, well, what happens if we both die tomorrow? Would we owe a death tax, an inheritance tax? Will the family be able to continue with the plan if you are not there, i.e. do you need insurance to fill that gap? So understanding all of this data will really help you with your life to say, okay, well, actually we're okay if something happens to the main breadwinner or the main income earner. The investments can pick up the slack. It's less of an issue. because we've done the plan. So it's important to understand, okay, what will that be? And even the case of I want to sell my business or a small business, is that enough money for me to retire on? Do I need to hit a certain level of income or a certain valuation of my business to make sure that I can provide an income going forward into the future? So we can model that in your financial plan to say, okay, in 3 or 4 years time or 5 years time, you want to sell that business. You need to hit this valuation because that will give you an income that will last into your 90s, for instance. And that will be all included, all of those goals and aspirations, all of that bucket list. And that's the type of planning that you can do that will help you in your business life. And the same with how much is the minimum money to survive on. The building the plan is the first step. The process is where the real value lies. So you're asking all of these type of questions to yourself, and then you're building your plan around these goals and aspirations. So the more you ask these questions, the more you add in your bucket list, your goals, the more that you can actually predict whether or not your financial life will be able to support that. So when we run through the numbers, I've given it to a graph on the right-hand side here. The top part is a timeline. So there we've got just quite a simple example of someone adding in that their son and daughter want to go to university and their retirement period. We can add in the bucket list at that point, and this is your financial plan. The graph below that is the cash flow forecasting. So that's all of the income that you would earn over the period from the various different sources, and that includes all of the expenditure. So if you add in more goals and more bucket lists, then that's where your expenditure will go to. And you can decide whether or not you have a shortfall or you have a surplus. So the red is a shortfall, and then the blue is that you're fine. There's enough money there to provide for those expenses. We change the calculations, we change the assumptions, and we get to that point where we understand, okay, we're okay, we're going to have enough money. Maybe we can spend more if we add in more goals and more aspirations. What will that mean? So all of these financial planning will help you in your life, take the stress away, build your plan, build your investment portfolio based on your needs in the future. In the top example, we've got someone who's say 38, but we've got a mortality date of say 94. Their investment period, therefore, is 50 odd years. For them to be able to have an income from an investment portfolio, it's not necessarily useful for them to have any fixed interest in the initial years. It's not going to add any value to them over the longer period. If they had fully equity, then their period of investment is 50 years. There is enough of a time frame for them to hold those assets. So the last 6 weeks where we've seen this temporary correction, and it's always a temporary correction, wouldn't make that much difference to them over a 50-year period, because they're in the great companies of the world. They're invested in a globally diversified portfolio that is not going to have too much of an impact on them. When we stress test this for clients, we can show how the financial plan is robust enough to take this changes and these falls, and it's not going to have an impact on them into the future. So if we stress tested now, we've had a correction, that bottom graph would either be less red or more blue, depending on where those assets are allocated. So previously we talked about having those investments and making sure that the investment rates are attributed to what the allocation is or where they're held. This is where you're actually starting to stress test it. You can do something called a Monte Carlo scenario. You're saying, okay, what happens if the market crashes 20%? What will that make to our individual finances over the longer period? So the forecasting will help you understand that. Plan your bucket list, add that in. Scrutinize that spending plan. Make sure that you've done your budget for the year, you've looked at how much you're going to spend, The end of the year is that reflection point. How much did we spend? Did we overspend? Did we underspend? Can we allocate more money to an investment? Can we pay off more on our mortgage? Should we make those extra £50 or $50 a month into an investment plan? So where have you got disposable income? Where can you allocate that going forward? Can you invest in yourself? Do you want to go and do another university degree? Do you want to do another course? Do you want to spend time on, spend money on yourself? It's part of that spending plan. So making sure that you're on target, and the end of the year, again, is a very good point to do it. You can have that mince pie, you can have that glass of mulled wine, and you can go through your spending plan, your budget for the year to see whether it works. It tends to be quite a dull process, but it can be very, very important to see whether or not you are hitting those goals. And doing it once a year, okay, you should probably do it a bit more often, but it's a good point to start it. So scrutinize your spending plan. Where's your money going? Can you save money elsewhere? Are you allocating it to the right areas? Get insurance. We always add this in because it is very, very important. Home insurance, car insurance, they're pretty sort of compulsory, but people don't tend to insure their human capital. They don't to insure their life, their ability to earn an income into the future. The trigger points, i.e. the end of the year, is, okay, have you added another member to your family? Have you had children, for instance? Have you bought a house? These are good trigger points to say, okay, how's my insurance up and running? And when we go back to that financial plan, we can say, well, we've added in our bucket list. We've added in how much we need to spend now. With the new family addition, your new son or your new daughter is going to go to university in 18 years, or they need to be paying school fees from the age of 5 onwards. Okay, we need to build that into our financial plan now. We need to know whether or not we're going to have a shortfall going into retirement because we've added more money into university. Do I need to update my insurance? So all of these kind of things are helping you understand where you are today. And then write a will. Now, this is part of a bigger estate planning question, and writing a will is just a component of that. But it's a good thing that everyone thinks that they should do. At the end of the year, should we write a will? But it is a case of, okay, can you do will substitutes? So actually what you're trying to do is take assets off the will, use other options that will be able to pass the assets onto your beneficiaries or your loved ones as quickly as possible. And this is a bigger problem in the expat world, where we've got multi-jurisdictions, different currencies, different languages, different time zones. So using a will substitute, for instance, you can have putting a property into joint names. It just means that if something happens to one of the owners, the asset will pass straight to the other, so husband and wife. So you don't need to add that into the will, it is automatic. Putting a nomination of beneficiaries on insurance, maybe using a trust, because you need the confidentiality. You need to be able to know that those assets are encased in a robust vehicle. So these are examples of what you can do in terms of getting those assets off the will. But a will is important because it avoids probate, or avoids probate issues, and it gets the assets to those beneficiaries as quickly as possible. The probate process in different countries is different. There are different costs. You need to understand what is the probate process for one particular asset in a country, and how can you avoid the problems and some of the administration that goes along with that. It's generally an incredibly trying time when you've lost a loved one, and you don't necessarily need to be worrying about how do I get those assets to the family, because you need to spend the money when you're in a different part of the world and you need to go through the probate and understanding what the paperwork and the administration is. So a will would certainly help with that. A will substitute will be even better. So it's a case of, okay, let's do our estate plan. And the end of the year is a good reflection point for that. Giving to charity. This is one's really to do with the fact that if you're in Singapore, if you donate to a registered charity, and it's got to be registered, the Institute of Public Charter has the list of the charities. Not all of them are approved. But if you make a donation, then it will be deducted from your assessable income. And actually, it will be deductible at 2.5 times the original amount. So we've given an example here of a $300 donation, which means that $750 will be deducted from that assessable income. You're making a contribution to probably a really good cause. You're probably helping people. Maybe it's a cancer charity, or it's the charity that we do is the Singapore Repository Theatre to help people go along to theatres, do the arts. These are deductible, and they're good for the community, and it also saves you tax. It can be the same in other countries as well. So if you make a charitable contribution in the UK, then this can reduce your inheritance tax bill. And the same in Australia, if you make a charity contribution, then it can reduce a tax bill there as well. So depending on what the country is, maybe it's worth looking at saying, okay, we can make a charity contribution. We can do good in the world at the same time. And it's Christmas period. It's the end of the year. It is a time when people give gifts. They make their time available to the less fortunate. So do that at the same time. Use your tax allowances and tax returns. Some countries will have annual tax allowances that will apply to even though you're an overseas resident. You may need to do a tax return for certain property or other assets, depending on where those are held. So understanding that, okay, you need to make a tax allowance, you can claim if you have an asset in a particular country, or you need to do those tax returns. So if you've got property in the UK, then you need to do your tax return by January next year. So it's always good to start now. Same with obviously the charity contributions in Singapore. US and Australia have tax allowances that you should be taking advantage for this year. Australia, we're halfway through the tax year, but it's always good to, as again, another reflection point. So there are things to do at the end of the year. Again, you probably got a little bit more time than you didn't have at the start. It's a natural point to look back. It's a time for giving. You're probably a little bit more relaxed. Why not just do some end of year planning? There are my details. If you need help or you've got some questions, then by all means get in touch, and maybe we can help you out. So have a good Christmas and New Year. I hope it all works out well for you.